A current ratio of 2.0 looks like a perfect textbook score. Financial gurus would tell you this company is safe, but behind that perfect number lies a dirty Wall Street secret. This company could be a ticking time bomb heading straight into bankruptcy within the next 90 days. How? The trap is hidden inside the formula itself: inventory. If a financial crisis hits tomorrow morning, a business cannot pay urgent bills with unsold products rotting inside a warehouse. Creditors demand cold, hard cash, not dust-collecting stock. That is why elite investors completely ignore the current ratio illusion and run a brutal, naked measure of survival, the acid test ratio, or quick ratio. In my previous video, we broke down the current ratio, which simply measures a company's ability to cover its short-term debts using its standard short-term assets. If you haven't watched that breakdown yet, make sure to check it out. But as we just discovered, the current ratio has a massive blind spot because it treats slow-moving inventory the same as actual cash. So, how does the acid test give you the brutal, naked truth? Let's look at the simplest form of the formula first. Quick ratio equals current assets minus inventory over current liabilities. By doing this math, we remove the slowest moving asset from the equation. What is left behind is what we call quick assets: pure cash, liquid short-term investments, and accounts receivable. This is the ultimate emergency fund of a business. But what if you want to analyze a balance sheet like a true Wall Street professional? To get the absolute most accurate number, we must make two advanced adjustments to that basic formula. First, look at the top half. Alongside inventory, we must also subtract prepaid expenses. Think of things like prepaid insurance. If a company pays its entire annual insurance premium in advance, that value is locked in for the year. You cannot suddenly call the insurance company tomorrow morning and demand a cash refund to pay off an immediate debt. That cash is long gone. Second, look at the bottom half. We take the standard current liabilities and subtract the bank overdraft. Why? Because in the real corporate world, commercial banks rarely force a business to pay off a structured overdraft facility overnight. It's a rolling credit line. When we make these two adjustments, it leaves us with the ultimate institution-grade formula: quick ratio equals, hey, current assets minus inventory plus prepaid expenses divided by current liabilities minus bank overdraft. Now we have the naked truth. Let's stop talking theory and look at some real numbers. Imagine we are analyzing a company's balance sheet with the following financial data. The company holds total current assets of $130,000, but inside that number, $44,000 is locked up in inventory and $3,000 is tied up in prepaid expenses. On the other side, their total current liabilities stand at $75,000. However, $33,000 of that is actually a structured bank overdraft. Now let's plug these numbers into our advanced formula. First, our true liquid assets, $130,000 minus $44,000 plus $3,000 equals $78,000. Second, our adjusted liquid liabilities, $75,000 minus $33,000 equals $42,000. Now we divide our true liquid assets by our liquid liabilities. $78,000 over $42,000 equals 1.85. Our final quick ratio is 1.85. The standard institutional benchmark for this ratio is 1.0. This means for every $1 of short-term debt, the company should ideally hold at least $1 of near-cash assets. With a score of 1.85, this specific company is in an exceptionally strong position. They can easily wipe out their short-term debts without selling a single item from their warehouse. But wait before you go and hunt for companies with a quick ratio of 4.0 or 5.0. Here is one final strategic warning. In corporate finance, an excessively high ratio is also a dangerous red flag. It tells us that management is being overly conservative. Instead of reinvesting their cash to expand the factory, launch new products, or beat the competition, they are simply hoarding idle money in a low-interest bank account. It signals operational inefficiency. So remember, the sweet spot is a balanced ratio. The next time you analyze a stock, do not blindly trust the current ratio illusion. Strip away the inventory, run the acid test, and see if the business is truly bulletproof. In our next financial breakdown, we are going to push liquidity to the absolute extreme and dissect the cash ratio. If you found this analysis valuable, hit that subscribe button, smash the like button, and drop your thoughts in the comments below. Invest smart, and I'll see you in the next breakdown.